As we approach the end of 2024, it's the perfect time to review your tax situation and save some money this year and/or ensure that you are limiting your lifetime tax liabilities. Hey everybody, Tim Dorman here, founder of Eagle Ridge Wealth Advisors. And in this video, I'm going to cover 8 year-end tax saving strategies that you might want to consider for yourself. First up, retirement plan contributions. There are going to be limits and restrictions on what you can contribute, but you want to ensure that you are taking advantage of your retirement plans to make sure that you're setting money aside for the future, whether it be in a tax-free Roth 401k or Roth IRA or a traditional 401k or IRA. You're going to want to make sure that you're setting money aside for your retirement. People in higher tax brackets are probably going to want to use the traditional 401k and IRA to defer income. And if you are in a lower bracket, you're probably going to want to go in the Roth direction. So your earnings will grow tax-free in the future, but you do pay tax now. You will also want to be mindful of the contribution limits for 2024. And of course, if your employer offers a match like 3, 4, 5, or 6% or whatever, you will certainly want to max that out to make sure you get the match. Tax saving strategy number 2, tax loss harvesting. For those of you that may have watched some of my other videos, you will know that this is not one of my favorite tax saving strategies because, of course, it means you've lost money. Nobody likes that, but it can be a good tool for saving taxes in some years if you have these losses. Tax loss harvesting is a strategy that is used to reduce taxes owed by selling investments that have lost money, as I mentioned. Now, investment losses can be sold to recognize a tax loss to offset any realized gains and/or up to $3,000 of ordinary income per year. Tax saving strategy number 3, we have tax gain harvesting now too. Now, as you might have guessed, tax gain harvesting is the opposite of tax loss harvesting. Who knew? Why would you want to harvest gains? Well, if you're in a lower tax bracket, you can recognize long-term capital gains and pay a 0% tax rate. Yes, 0 taxes. In 2024, the 0% tax bracket for long-term capital gains goes up to a taxable income of just over $47,000 if you are filing as an individual, and goes up to just over $94,000 for married couples filing jointly. So that's quite a bit that you could get in that bracket, right? 4th tax saving strategy, Roth IRA conversions. If you watch any of my videos, we obviously love this one. These are one of our best tools to limit lifetime tax liabilities. Roth conversion means converting tax-deferred money to a Roth IRA, which can then grow tax-free if it's qualified. If you have tax-deferred money in, let's say, a 401k or 403b or any tax-deferred retirement account, you can simply roll that money to a traditional or rollover IRA, and then you can convert that money to a Roth IRA. And you can hypothetically convert it all at once, but you probably won't want to do this if you have a sizable tax-deferred account, because any amounts that are converted are going to be taxed at ordinary income. So you could pay a very large amount if you do it all at once. You'll probably want to do it over the course of multiple years by filling up lower income tax brackets in your gap years. And your gap years are going to be the years between retirement and RMD age or required minimum distributions. Now, once it is in a Roth IRA and it's qualified, it won't be subject to future taxes at all. Good stuff, right? Also, Roth IRAs are not subject to required minimum distributions, and beneficiaries can inherit Roth accounts tax-free as well. This is an important tool because when do we want to pay taxes? Well, we want to pay them when they are the cheapest or lowest, right? Now, this year and 2025 are going to be good years for Roth conversions because we have historically low tax rates resulting from the Tax Cuts and Jobs Act of 2017. Now, this is set to expire at the end of 2025. So it might make sense to convert an amount that will take advantage of our historically low ordinary income tax brackets. Now, you also might ask, well, Tim, what if I'm retired and I have investment gains that I could harvest, and I also have a large tax-deferred account that I could convert? What should I do? Great question. And of course, everyone's situation is different, but as a rule, I believe it's generally better to do Roth conversions rather than try to recognize the 0% capital gains bracket. Why is that? Well, first of all, our capital gains and qualified dividends brackets have lower or preferred rates compared to our 7-bracket ordinary income tax rates. So we want to get the potentially higher future tax money moved first in a lower bracket to help lower our future tax bill. And second, tax-deferred money has required minimum distributions, so Uncle Sam, of course, can get his pound of flesh at some point in the future, no matter if we need to take that money out or not. And third, if you do not sell appreciated stocks and you die, your heirs are going to get this step up in basis, which means that they would receive the stock at whatever value the stock was the day you passed, rather than the price you purchased it at. Now, tax saving strategies 5, 6, 7, and 8 pertain to charitable giving, and they may overlap, and sometimes you can use a couple of strategies together. So, our 5th tax saving strategy is charitable donations of appreciated stock. As you may know, you can use after-tax dollars to get a charitable deduction, right? And this can be used to reduce the amount of taxable income that you have. But if you donate appreciated stock, you can get a deduction for the full market value of the stock, and you won't have to recognize any of the gain on that appreciated stock. So you're saving even more in taxes. The charity gets the full amount, you don't pay any tax on it, and they can sell the stock and not pay any taxes since they don't have to pay any taxes in the first place. The 6th tax saving strategy, donate to a donor advised fund. This will basically work like a charitable IRA. You can contribute cash or appreciated securities, like in the former example, to the fund and receive an immediate charitable deduction equal to the fair market value of the contribution. You can then invest the proceeds, which can earn income on a tax-free basis moving forward. Then, of course, moving forward, you can use that donor advised fund to pay out to whatever qualified charitable organization you choose. All right, 7th tax saving strategy, bunching or stacking deductions. Now, since our current standard deductions are relatively high, most of us, around 90% of the country, are not itemizing deductions. But if you give charitably, you can donate multiple years at once to receive a large itemized deduction all in 1 year and then use the standard deduction in other years. And you can donate to your donor advised fund to accomplish this, and then of course decide where and when to send the money out of your donor advised fund. For example, let's say that you are married and you typically give around $10,000 a year to charities. And this year, your total itemized deductions are going to be $25,000 before giving to charities. Well, this is, of course, under the standard deduction of $29,200 for 2024. But if you bunch or stack 3 years worth of charitable deductions into $30,000 this year, then you can itemize and add the $30,000 to the $25,000 this year for a total itemized deduction of $55,000. So if you are in the 24% tax bracket, this increase in itemized deductions would decrease your taxes by $6,192. So pretty good. And of course, you could do this every 3 years or 2 years or 4 years or whatever makes the most sense for you. Now, the 8th and last tax saving strategy, but certainly not least, is qualified charitable distributions. Now, this one is only for those over the age of 70 and a half with money in a tax-deferred IRA. With this one, there is no deduction, but you can use pre-tax money to donate, and it will never show up on your tax return at all. So it's actually more beneficial than a deduction. If you use this one, you're going to need to ensure that the money goes directly from your IRA to the charity. It cannot go to your accounts at all, or you will have to pay tax on it. And if you do a QCD or qualified charitable distribution, you will need to tell your tax preparer because custodians do not send out a form for this one. And if you are subject to RMDs or required minimum distributions, you can send all or part of the RMD to charity with this qualified charitable distribution method. All right, bottom line, these are 8 year-end tax saving strategies to help you save money on taxes this year or future years, depending on your personal situation. And if you have any questions regarding this video, feel free to reach out to us in the comments or at our website, erwealth.com. Thanks for watching, and I'll see you next time. Once again, Tim Dorman here, founder of Eagle Ridge Wealth Advisors. And if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.